Hi, I'm TaxMax. Let's break down today's tax topic.
In corporation tax, the concept of associated companies can significantly affect how much tax a company pays. Associated companies are companies that are under common control. This concept is particularly important when determining which corporation tax rate applies and how profit thresholds are calculated. Association does not depend on whether companies are in the same group for accounting purposes. Instead, it depends on whether the same person or persons control the companies. Control can exist in several ways. A person may control a company through share ownership. Control can also arise through voting power or through rights to income or assets on a winding up. In many cases, individuals control companies directly. In other cases, control can be exercised through other companies. The rules also contain attribution provisions. These mean that rights held by certain connected persons, such as close family members, may be treated as belonging to the individual when assessing control. It is important to distinguish between group companies and associated companies. Group membership is relevant for reliefs such as group relief. Associated company status is relevant for corporation tax rate thresholds. A company can be associated with another company, even if they are not in a group. The main practical impact of having associated companies is on the corporation tax thresholds. As at September 2025, the lower profit limit of £50,000 and the upper profit limit of £250,000 must be shared between associated companies. This sharing applies by dividing the limits by the number of associated companies. For example, if a company has one associated company, the limits are divided by 2. If it has 2 associated companies, the limits are divided by 3. These reduced limits are then used to determine whether the company qualifies for the small profits rate, the main rate, or marginal relief. If a company has a short chargeable accounting period, the profit limits must first be time apportioned. After that, the apportioned limits are divided by the number of associated companies. This means that short periods and associated companies can combine to reduce thresholds significantly. Associated company status is tested on a daily basis. If companies become associated or cease to be associated part way through an accounting period, the profit limits must be apportioned to reflect this. This can require careful calculations, where ownership changes during the year. Close companies are commonly affected by the associated company rules. This is because ownership by individuals and family members often leads to common control. Understanding who controls a company and how attribution applies is therefore critical. Putting it all together, associated companies can materially affect corporation tax outcomes. They reduce the profit thresholds used to determine tax rates. They can push companies into higher tax bands or into marginal relief. And they require careful monitoring where ownership structures change. Later episodes will build on this by looking in more detail at control tests, attribution rules, and practical examples.
Educational content only, not advice. Rules can change.